$5,000. I want you to stop what you're doing for a second and just let that number sink in. $5,000 for a single ounce of gold.
Yeah.
It's Saturday, January 24, 2026, and if you haven't looked at a chart in the last couple of days, you'd think I was reading from some, I don't know, sci-fi script about hyperinflation.
It does feel a little surreal, doesn't it? I
Yeah.
mean, we've talked about these psychological barriers for years.
Oh, for years.
Breaking 2,000, then 3,000. But 5,000 is just, it's different. It's a real milestone number.
Yeah.
And as of yesterday's close, we are right there. We're knocking on the door.
We're not just knocking, we're breathing on the glass. We are right there.
Yeah.
And look, the mission for us today isn't just to, gawk at the price, though I admit I'm doing a little bit of that.
It's hard not to.
It is. We've got this huge stack of sources here, trading charts, fund flows from the ICI, COT data, geopolitical updates. And we really need to figure out why this is happening because, on the surface, it looks like a total panic move.
Right. The traditional playbook.
Exactly. When gold goes parabolic, it usually means the world's on fire.
That's the fear trade.
But here's the part that just doesn't fit. We dug into the volatility data, the so-called fear gauge, and the stock market. I mean, if the world is ending, why is the VIX dropping? And why is Amazon hitting new highs?
And that is the multi-trillion-dollar paradox we have to unpack today. It is so rare to see a quote-unquote fear asset and greed assets all rallying at the exact same time. It suggests we're not dealing with just a simple crisis play. This is something more structural.
Okay, let's get into the weeds then. We have to start with the raw price action because just saying gold is up is a massive, massive understatement.
It really is.
So walk us through the numbers.
Okay, so let's set the baseline. As of the close on Friday, gold, that's the XAI-USD pair for anyone tracking it, closed right around $4,984.
Up 1% on the day.
Up about 1% just on Friday, yeah. And after-hours trading kept it alive. It's hovering at $4,987.
So we are literally $13 away, one decent lunch order away from $5,000.
We are right there. But to really get the violence of this move, you have to look at the last 2 weeks side by side. Our sources call it a tale of two markets.
I saw that. It's like a switch just flipped. So take us back to the week before last, January 12th.
Okay, so that week was what traders would call a slow grind. It opened at $4,540, and it closed at $4,596.
Okay.
It was a solid green candle on the weekly chart, a net gain of about $55.
Which, let's be honest, in any normal market, a $55 gain for the week is great. You take that every time.
Oh, absolutely. It showed buyers were in control, but they were patient, accumulating. It was orderly.
And then came this past week.
Then came the explosion. The entire character of the market just shifted. We opened at $4,672 and closed at $4,984.
Whoa.
That is a $312 jump in 5 days.
$312. That's not a grind. That's a vertical launch.
It is. And from a technical standpoint, what we're seeing in the charts are described as independent bullish candles.
Okay, let's pause on that term. Independent bullish candles. I know it's technical, but help us visualize what that means for buyers and sellers.
So think of it like a tug-of-war. Usually, even in a really strong trend, you get moments where the other side pulls back a little. The price might dip, or it'll overlap with the day before.
Right. That's normal.
Very normal. Independent bullish candles means one side, the bulls in this case, they didn't just win. They dragged the other team clean across the line without slipping back even once. The price just kept stepping up without really overlapping with any prior weakness.
So basically no hesitation, no moments of, hey, maybe we should sell here.
Very, very little. And that's really significant because it suggests we haven't hit the exhaustion zone yet. Usually after a $300 move, you'd expect the buyers to be totally gassed.
The tank should be empty.
The tank should be on E. But the technical suggests the momentum is still there.
That is terrifying if you're short this market. But if the tank isn't empty, where's the ceiling?
Well, the next resistance zone is sitting right there at that 5,000 to, say, 5,050 range. And that is pure psychology.
The big round number.
Exactly. Humans love round numbers. There are probably thousands of automated sell orders sitting at exactly $5,000, just waiting.
But the floor has moved up with it, right?
Aggressively. If we do see a dip, the new support levels are around $4,900, maybe $4,860. I mean, just 2 weeks ago, those numbers would have sounded like a crazy ceiling.
And now they're the floor.
Now they're the floor.
Okay, so we've got a rocket ship, the engines are firing, and the launch pad is moving up right behind it. But we have to answer the why. What is the fuel here?
It's a mix. It's some old school fear and a lot of modern currency debasement. If you look at the headlines from early in the week, the spark was definitely geopolitical. The
Yeah.
sources are calling it the Trump factor.
Yeah, I saw this in the notes. We had rhetoric about tariffs on Greenland, which I have to say sounds a little random. Why does a trade spat over Greenland move the entire global gold market?
It does sound obscure, but you have to think about what Greenland represents. It's not about the ice. It's about rare earth minerals. It's about strategic positioning in the Arctic. So when you hear threats of tariffs there, plus more disputes with the EU, the market reads that as a fracturing of global trade.
It's a signal, a resource war signal.
Precisely. And markets absolutely hate that kind of uncertainty. Then you add in the threats regarding Venezuela, which is an oil play, obviously, and you just had this massive spike in anxiety early in the week. That was the match.
Okay, so that explains the fear part. Trump rattles the cage, people get nervous, they buy gold, tale as old as time. But you mentioned the fear gauge, the VIX, is actually dropping now. So if the fear is fading, why is gold still screaming higher?
Because the story shifted midweek. It went from being a war story to a dollar story. We have to talk about the DXY.
The US dollar index.
Yeah.
It's getting hammered, isn't it?
It looks incredibly weak. The DXY is down at 97.46. That's almost a full percent. And you have to remember, gold is priced in dollars. It's a seesaw.
So if the dollar gets lighter, gold just looks heavier.
Looks heavier and more expensive. And it's not just gold. The euro is strengthening up to 1.18. The British pound is at 1.36. The dollar is just losing ground against everything.
But why? Why is the dollar dropping now? Is it just the tariffs?
It's the market's reaction to the tariffs. The thinking is, if the U.S. gets into a real trade war, the Fed might have to cut rates or, print money to cushion the blow.
So gold isn't necessarily becoming more valuable in a vacuum. It's that the measuring stick we use, the dollar, is shrinking.
That's a perfect way to put it. It's an active repricing.
Yeah.
Investors are looking at their cash and saying, I don't want to hold this melting ice cube. And they're swapping it for the hardest asset they can find.
Which brings us back to that paradox I can't get over. The VIX. The volatility index. Usually when gold screams, the VIX is screaming right alongside it. But our sources show they're going in opposite directions.
It's fascinating. If you look at the timeline, early in the week, Tuesday, Wednesday, when the tariff news was fresh, the VIX spiked. It hit 20.
Right, into the nervous zone.
That's the knee-jerk panic. But by Friday, it cooled all the way down to 15.68. I mean, that is a very calm number. It tells us the initial panic just faded. The market basically shrugged and said, we can live with this.
And the proof of that is in the stock market. I'm looking at these tickers. NVDA up 1.5%, Amazon up 2%, Microsoft up over 3%.
Yeah.
These are not defensive stocks. You don't buy NVIDIA if you think the world is ending.
You absolutely do not. This is what we call a risk-on environment.
Okay, but challenge me on this then. If we're risk-on, if everyone's feeling brave and buying tech, why didn't they dump gold? I mean, usually you sell the safety asset to go buy the risky one. Why are they buying both?
Liquidity. That's the key. The market smells easy money.
Yeah.
They believe the central banks are going to keep the spigots wide open to fight off any trade tension fallout. And when there's that much money sloshing around, it flows into everything, it flows into Amazon, and it flows into gold.
So it's not that people are scared of war anymore. They're just flush with cash, and they're scared of holding that cash in dollars.
Exactly. It's a dual-engine rally.
Yeah.
Engine 1 was the geopolitical fear. That got the move started. Engine 2 is the liquidity and the dollar weakness, and that's what's sustaining it. It's a perfect storm.
That makes so much sense. It's the everything rally. Okay, I want to follow this money a bit deeper. We have this report from the ICI, the Investment Company Institute, and it tracks where the funds are actually going. And I saw this weird conflict in the numbers.
Yeah, the ICI report for the week ending January 14th is very revealing. On one hand, you have long-term mutual funds. They saw outflows of over $17 billion.
Which sounds bad. $17 billion leaving the building usually means people are cashing out and going home.
Traditionally, yes, but you have to see where it went. At the same time, ETFs, exchange-traded funds, saw net inflows of over $55 billion.
So they're not taking the money home at all. They're just moving it from their left pocket to their right pocket. Why? What's the difference?
Speed.
Huh?
A mutual fund's like a cruise ship. It's big, it's stable, but it takes forever to turn. And you can only get on or off once a day at the closing price.
Okay.
An ETF is a jet ski. You can buy it and sell it instantly right in the middle of the day as the market is moving.
Ah, so investors are getting twitchy.
They're getting tactical.
Yeah.
This shift from mutual funds to ETFs tells me investors want to be in the market. They are definitely risk-on, But they want that escape hatch. They want to be able to bail out instantly if that $5,000 gold price collapses or if the war talk heats up again.
Anxious aggression.
That's a good term for it, yeah.
I like that. It feels like the mood of the decade.
Okay.
Let's look at the traders themselves, the COT report commitments of traders. Who's actually placing these bets?
This is where the rubber meets the road. The COT report for the week ending January 20th shows this massive divergence. First, you got the speculators, your hedge funds, your money managers. They ramped up their net long positions to a 14-month high.
So the fast money is all in.
All in. They added something like 25,000 contracts. They're chasing this. But then you look at the hedgers. These are the commercial producers, the gold miners. They increased their net shorts.
This always confuses people. Why would a gold miner, a company whose entire business is digging up gold, bet against the price of gold?
They're not really betting against it like a gambler. They're locking in a guarantee. If you're a miner and gold suddenly hits $4,900, you are popping champagne.
Sure.
But you're also terrified it might drop back to $4,000 next week. So you short the market, which locks in that $4,900 price for all the gold you're planning to dig up in the future.
So it's an insurance policy.
It's pure insurance. And the fact that they're shorting so heavily tells us they think these prices are incredible, almost too good to be true, and they want to secure them.
While the speculators are betting it goes to the moon.
Exactly.
And right now, the speculators are driving the bus.
They are. But a word of warning here for you listening. When the speculators get this long, when everyone is crowded onto one side of the boat, it gets dangerous. If the story shifts, if the dollar suddenly rallies, the rush for the exit door is going to be violent.
So enjoy the ride, but keep your hand on the parachute cord.
Always.
We've been so focused on gold, but if we zoom out, it seems like the whole periodic table is having a party.
It's a broad commodities rally, absolutely. And silver is really the standout performer.
Silver finally broke $100.
It did. It's trading between $101 and $103. That's up 5 to 7%. And you have to remember, silver is a tiny market next to gold, so it moves much faster.
I saw that Barron's headline in our stack. Silver has surged. How to play the next move. Is it just riding gold's coattails?
It's often called gold on steroids, so there's that. But silver also has a huge industrial component, and that connects to the other metals. Look at copper. It's up nearly 3%, almost at $6.
And copper is Dr. Copper, right? Supposedly has a PhD in economics.
That's the nickname. The theory is copper only goes up if people are actually building things, wiring, electronics, houses. So the fact that copper is rising with gold tells you the market isn't just betting on a currency collapse. They're betting on global growth.
Which fits that whole risk-on story. The economy is still chugging along.
And even platinum is up 6%. Energy prices, too. Oil's back to $61. Natural gas is up over 4%. This is a classic reflation trade. The market is just betting that the price of everything real is going up.
Speaking of real assets, or at least assets that claim to be hard money, we have to check in on crypto. Is Bitcoin at this party?
It's at the party, but it's kind of hovering by the punch bowl. The total market cap is flat, but the institutional flows are massive. We're seeing reports that Wall Street scooped up nearly $500 billion in BTC and ETH.
$500 billion? That's not retail investors on their phones.
No, that is institutional allocation. And it just reinforces that theme, get me out of cash. Whether it's gold, silver, or Bitcoin, the big money is diversifying into things the government can't easily print more of.
I want to circle back to the miners for a second. We talked about them hedging, but what about their stock prices?
Oh, they are flying. The Junior Gold Miners ETF, that's GDXJ, it's up over 2%. And this is a really great lesson in leverage for anyone watching this space.
Explain that math. Because people assume if gold goes up 1%, the miner just goes up 1%. It's not how it works.
Right, not at all. Think about it this way. Let's say it costs a mining company $3,000 to dig 1 ounce of gold out of the ground. That's their fixed cost.
Okay, so if gold is at $4,000, they make a $1,000 profit.
Correct. Now, imagine gold goes from $4,000 to $5,000. That's a 25% increase in the gold price.
Right.
But for the miner, their profit just went from $1,000 to $2,000.
Their profit doubled. 100% increase.
Exactly. That is operational leverage. A small move in the metal price creates this huge explosion in the miner's profitability. And that's why you see stocks like GDXJ acting like high-octane versions of the metal itself.
So if you really believe in this breakout past 5,000, the miners are the aggressive way to play it.
The way to supercharge the trade, yeah.
So let's pull all this together. We have gold at what, $4,984. Silver's over 100. We have a weak dollar, but resilient stocks. And a market that's just shrugged off a trade war for a liquidity party.
It really is the Goldilocks zone for commodities. You have just enough geopolitical fear to keep a solid floor under the price, but just enough economic optimism, that risk-on feeling, to keep the liquidity flowing. And you've got a weak dollar as the wind in the sails, all the cylinders are firing at once.
It sounds perfect. Almost too perfect. So looking ahead, what's the bear case? What could derail this train right before it hits 5,000?
Well, the psychological barrier itself is the first hurdle. We might bump our head on $5,000 a few times. Profit-taking is just human nature. But the bigger risk is actually, well, it's peace.
Peace.
Think about it. We're assuming this risk-on phase will keep going alongside the gold rally. But what if the geopolitical tension just vanishes?
Yeah.
What if Trump comes out and says, just kidding about Greenland and we love the EU now?
The fear premium just evaporates.
Right. If the world suddenly looks too perfect and bond yields start to rise because the Fed backs off, investors might dump their gold to chase that tech rally even harder. Gold relies on just a little bit of distrust in the system. If everyone trusts the system again, gold loses some of its shine.
That is a provocative thought. We're all rooting for gold to hit this milestone, but in a way, gold is kind of rooting for a little bit of chaos.
Or at least, it's rooting for a devalued dollar. That's the real key. Has the dollar been permanently reset to a lower level? If the answer is yes, then 5,000 isn't the peak, it's the new standard.
The new normal. Well, my eyes are going to be glued to the DXY and the VIX this week. Those seem like the two compasses we need right now.
Absolutely. Watch that dollar index.
Yeah.
If it breaks below 97 in a meaningful way, $5,000 gold will be in the rearview mirror very, very quickly.
What a historic week. It sounds like next week could be even wilder. Thanks for breaking this down.
Always a pleasure.
And for you listening, thanks for taking the deep dive with us. We'll see you on the other side of 5,000. Stay curious.